Okay. Okay, guys, so we'll start from where we left off. Now, why do we even mess with all these accounting standards? And why do companies need independent audits? Well, if you've even barely glanced at the newspaper once a month or once a year, we know why, don't we? We know even after the sweeping reform that happened with Congress in regards to Sarbanes-Oxley Act of 2002, there continue to be the Madoffs of the world, the Petters of the world. It's not going to change. But these standards have placed greater penalties on those individuals that are directly involved and hold accountants, CPAs, to a much higher standard. So standards basically are created so that we all use the same forms of measurement. So when we provide financial statements, we all have certain guidelines in which we need to adhere to. How do we measure transactions? How do we record transactions? How do we determine what is an asset? How do we know we can record something as an expense? How do we create estimates? Allowance for doubtful accounts. What methods are allowable per FASB for estimates? For depletion also. And so we need to have these accounting standards so we can compare an apple to another apple, okay? We also have a little bit of an issue because even though we have these standards in place, they're always just not enough to make sure people are adhering to the standards. We know of GAAP, Generally Accepted Accounting Principles, and we now have IFRS, where since about 2002, we began collaborating with the International Financial Reporting Standards Board to try to come together to create a common type of or common standards that we can have internationally or globally so we can compare apples to apples. Now, accounting standards require choices, judgments, and estimates. The thing that is great about accounting is there's a lot of professional judgment that has to happen. The thing that's bad about accounting is that there's a lot of professional judgment that needs to happen. So we don't always have a book that says, in this transaction, we must record it this way. So we need to use our professional expertise in order to make the most appropriate decision. And also when we're dealing with estimates, how do we know that when we're dealing with a garbage fill, a landfill, as the amounts change and vary, we have to then accelerate our costs. And how do we determine these things? How do we know we are accurately recording the appropriate transaction on the financial statements? Let's face it, as honest as people think they are, there is pressure to make their company look the best they can. Now, I would like to believe that I wouldn't do that, but I also believe that Petters didn't start out that way either. And again, maybe it's from years of seeing scenarios where you just realize, but for the grace of God, there go I. I don't believe that the Enron guys, Ken Lay and Skilling, truly started out as bad boys. But maybe through a series of pride and confidence and then pressure to continue with the profit soaring and the pride, the pleasure of enjoying that, people start making poor choices. There is a fraud triangle. I'm just going to put it online here real quick. Actually, I'm going to put it on the board. There is something called a fraud triangle. How many of you guys have heard of this in class? Where'd you hear of this? There is a fraud triangle. What is it? There's some form of pressure that gets someone to decide, maybe just this one time I'll do it a little different. I'm trying to think what the third one is. Yeah. Then we somehow that has to be there. Actually, all three of these have to be there in order for fraud to occur. But there's a pressure. Gosh, I'm going to get this $10,000 bonus if I get this financial statement done this week. And then there's an opportunity that opens the door for you to make poor choices. That allows you to step into the lion's den. And somehow in all of it, we rationalize it. This company's making enough money. It doesn't hurt for them to give me this. Or Madoff. Gosh, I've got to keep these earnings showing. I need to pay back these clients that want some of their principal back. I got to do this. They find a way, because of their ability to control or not have separation of duties, they have a manner in which they can step in the door, have the opportunity to allow the wrong behavior to occur, and they somehow rationalize it. I'll fix this next month. I'll fix this next year. I won't do it again. Do you get what I'm saying? And so, while I do not by any means believe that, more are corrupt than not, I don't believe that. But I think that there's pressure, and we're foolish not to think that it's out there because we see it over and over again. So even though we have these standards, we still need an external party to check the work and make sure that, in fact, what's being reported is, in fact, accurate. Auditors are external auditors. They're external. They're independent from the company. And they are required to go through a systematic process of looking at the financial statements and then testing those financial statement assertions. These assets, are they owned? Are they valued correctly? Are they measured right? So they have to go through a series of tons of tests to confirm that, in fact, the company who prepares the financial statements, the management, in fact, reported their financial position and their financial revenues and expenses correctly. So we need auditors, not just for inside the company, because if they want to screw themselves, that's fine, but we need auditors to protect the public. Ultimately, auditors are here so the public can rely on these financial statements. What do auditors provide? Oh, what was that? I don't know what they're trying to say there. Okay. Now, this accounting information and how we determine everything you've learned even so far in Principles 1 and 2. How do we know what a business transaction is? How do we evaluate it? How do we record it? Where do we record it? What date do we record it? How much do we say it is? All of these various methods we're learning are created by standards. These standards are set up so we all work the same method, so all transactions are handled in a similar fashion. When we deal with various estimates and methods and judgments that companies need to make in order to apply these standards, that's where we get into problems. For example, WorldCom. How many of you guys remembered WorldCom back in the 90s? WorldCom was a huge telephone company that basically went under, but their stock went gangbusters, and their company looked great until it was exposed that some of their leases, which was basically like renting or leasing cables underneath the ocean, they didn't actually own them, they leased them. But instead of showing it as a, quote, lease expense or rent expense, they capitalized them or showed it as an asset on the books. So what did that do? That made their income look much higher. That made their assets look much higher.
It inflated their value.
Totally. And then finally, when someone squealed and they had to go back and restate their books, take them off as an asset, put it on as an expense, guess what happened? Ooh, they totally went down. So would I have invested like a dummy in that company had I known the true story? Probably not. But here they're going gangbusters, making money. They could do no wrong. Many people invested based on that information. Now, when an auditors were a part of the mix and are part of the problem or part of the fraud, Arthur Andersen was. They knew about it. But again, everyone was covering themselves. But ultimately,
they totally ran into that triangle situation.
Usually fraud has to have those three ingredients for it to occur. So basically, we have a need not only for us all to apply those same standards, and expense is an expense, not an asset, but we need a check to make sure that in fact people are adhering to an outside source is checking to make sure that the company's financial statements are in fact accurate.
I missed the first point that you made when you said the standards. The problem is if they're not using them, or what did you say was the problem?
Well, basically, where the problem is there are standards, but standards can only speak to so much. But we all have subjective judgments based on them. We all have various estimates we use, and when they're not being applied accordingly, then we cannot compare to companies because there are times that true professional judgment can render different opinions or different results on the financial statements. But we want to, as much as possible, be able to have those financial statements comparable within companies. Now we're going to talk about the SEC a little. The Securities and Exchange Commission basically was created for the markets. So Congress created the Securities Act of 33 and 34, and basically the 33 Act was used for initial offerings to the public onto the exchange, and they had guidelines in place. And the Securities Act of 34 were for guidelines for companies that were continually registered and what they needed to provide to the Securities Exchange Commission. Now, as it relates to public companies that are traded on an exchange, legally the SEC has the authority to prescribe accounting principles and the practices of reporting for all public companies. However, and they want to do that so they can protect investors, maintain fair, orderly, and efficient markets, so capital formation can occur. So basically, their guideline is to protect the public, ultimately. The SEC really has the ultimate authority in creating these standards, but the SEC chooses to give that authority to the FASB, which we'll talk about in a minute. I guess I'm getting ahead of myself here. So the SEC is created for the public markets. There's two acts, the Act of 33 and the Act of 34. In the Act of 33, it requires, the Securities Act of 33 requires that any company offering securities for sale to the public in the primary market and then also the secondary market has to file a registration statement. So that initial public offering you hear about is governed by the Act of 33. So they need to file a registration statement. And then the Securities Act of 34 requires a bunch of documents that need to be provided by each public company. The Form S-1 is a registration statement. The 10-K is the annual report we hear about a lot, and I'm going to show you one. The 10-Q is a quarterly report. The 20-F is the report from non-U.S. companies. And then the Form 8-K is used to describe events that affect the company. So no Form S-1, the registration statement. 10-K, the annual extensive report. 10-Q, the quarterly report. 20-F, the extensive report for non-U.S. companies. And then Form 8-K, a report used to describe the significant events. What? I'm so sorry.
We say those.
Did you say to know all this?
Write it down. Okay? If you have a question on the report that is filed by non-U.S. companies is the 10-K, no, it's the 20-F. Okay? Okay, I'm going to show you real quick.
Pretty much no lecture, I'm assuming, right? Like the PowerPoint lecture, because that's what you're basing.
There will be some things, mainly in Chapter 2, I'm going to ignore, and still in Chapter 1. We're not there yet.
Is the PowerPoint, is that general from the book, or those are things you've selected?
General from the book. Okay, here's a 10-K of Target. This is the annual Target report from 2012. This basically is the form filed by the United States Securities and Exchange Commission, Washington, D.C. The annual report is pursuant to the Securities Exchange Act of 1934. Okay? Target, it shows where it's located, the employer ID number, the address. It shows common stock, par value, where it's registered on the exchange, and it continues on. Come on. It continues on, and it has a detail of so much stuff. I mean, it talks about the business, the highlights, the merchandise, how it's distributed, the employees, working capital, who its competition is, geographic location, talks about risk factors. It moves on then to discuss the MD&A, Management's Discussion and Analysis, that we're going to learn about in this class. I'm just kind of letting you see it right now. It shows all the financial data, all the statements. It shows information regarding corporate governance, the executive compensation, Stockholder information, related party transactions, about the principal, the accountant. It's an involved report, hundreds of pages. It has exhibits, schedules, and in, I think, the financial statements is where it shows the auditor's opinion also.
With targets for like 2013, they have a big credit card problem in the holiday.
Not until the end of 2013.
And but would it show on the 2013, is that an event that would? be
Absolutely.
mentioned? And so that would be under,
Well, it would be notes to the financial statements, it would be disclosed. That was a significant decline.
and so I'm thinking that's a significant thing that you would expect.
Absolutely, and it was required to probably file a report during that quarter to explain that significant decline. I heard that the second quarter of 2014 compared to the second quarter of 2013 of Target was down 80%. That's significant. I'm surprised it had that dramatic of an effect.
Well,
Canada.
I was gonna say, I don't think that was the only.
You're right.
cause of
The
that.
Canadian markets really got screwed up also. For some reason, what's happening? Why Canada's just not embracing them?
That's not how they shop. Canada's more friendly. I don't know who did their marketing and their business analysis, but they
So,
completely went in there with a bad strategy.
So it's like bad Greek yogurt, huh?
Pretty much, yeah. Like Canadians like their small markets, and because it's a more community feel, and they know the people. They're not very big into corporations,
They're
so
far more European.
yeah.
That's interesting, guys.
That's very common. Like the common person knows that, so I'm surprised a big corporation like Target it didn't, do like a market analysis or anything. I'm sure they did.
You would
but,
think they did, but again,
Yeah, maybe they thought they could overcome that with prices. I have no idea, but it's not about the money at the end of the day in Canada.
that's something you look at that and you would say, okay, we know about the credit card thing, but that couldn't account for 80%. So
yeah, you're right. But I do think that credit card thing did allow a huge hit for them. Huge hit. Okay, moving on, guys. I just wanted you to get a little understanding of what that 10K report looks like. So let's see here, the various statements you're going to be aware of, and the SEC has the ultimate ability to make those standards. They sometimes enforce certain regulations on companies and kick them out of the stock exchange. But the SEC, this is important, they delegate their authority to establish standards to the FASB and the International Accounting Standards Board. The SEC, while it has the permission or the ability to create the standards, they defer the standards to who's already done it, FASB, the Financial Accounting Standards Board, and also now to the new International Accounting Standards Board that is creating to come up with an international guidelines for reporting. Know that. The SEC exercises its most direct impact on accounting standards through its input and approval of standards that have been proposed but not yet issued. So, for example, back when Enron, the one reason Jeff Skilling, his one caveat to becoming part of the company, president of the company, was that the Arthur Andersen and ultimately the SEC had to approve this new type of accounting called mark-to-market, where they could book their profits, not when it necessarily happened, but when they were recognized. And as a result of that, that's how part of Enron's demise happened, is they were booking false profits. It was harder, it was much more subjective to determine what to book for profits, but the SEC approved them to do it. Do you see what I'm saying? So the SEC has a lot of power because they allowed Enron to use that new standard in order to book profits. So that's how they have their power.
Does that mean how you record it? Or
Mhm.
whatever?
How you record it. Instead of deciding what constitutes GAAP, the SEC has endorsed the concept of substantial authoritative support. Don't worry about that. Okay, we are not going to get caught up in this or focus on the evolution of accounting standards. Don't worry about this. Is it important? Probably, but I really don't care if you don't know all the details of how we have gotten to where we are today as to which board started. And I just, don't worry about that. Don't worry about the emerging task force. I do want you to know this, though. We used to have something called Financial Accounting Standards Board's Pronouncements, and they ended in 2009. So they had different kinds of pronouncements, and sometimes you'll still see those in old literature, but we don't have those anymore. Don't worry about what they were, just know we used to have pronouncements. We have now FASB Accounting Standards Codification. Now what this is, it takes all of our GAAP and it organizes it into a big binder or a database combined. This codification began in 2009, and the reason they've created now this codification where everything's combined and collated into one, the reason they created this codification is they wanted users to have access of all GAAP in one place, that the content truly is representative of what our GAAP states. If it's in one place and they approve it, it's going to be right. And also to create a system that's up to date, including the most recently released standards. So we now have a new format database that is kept current, kept up to date, and monitored, so we know what in fact are our GAAP standards. It is now, remember this, the only source of GAAP for U.S. companies to determine how to record transactions, events, or circumstances. We now use this codification as our only source to go to determine how transactions should be handled. Period. Okay? How are you guys doing there?
Do you need authority to access that, or, I mean, I don't really want to, but if I wanted to access that, could I?
We will have, I'm going to provide you with some different pieces to it in this class that we'll talk to. Now, this framework, this big codification database contains 6 different sections. There's areas, there's topics, subtopics, sections, and subsections. Okay, don't worry about that. Don't worry about financial procedures. Okay. The International Accounting Standards Board and the IFRS, this is IASB, the International Accounting Standards Board. This is the board that is in the process of trying to continue to create the international financial regulation standards, which are basically used in a lot of countries in the world, 120 countries. We use GAAP, generally accepted accounting principles. The rest of the world uses IFRS, and we're trying to find a way in which we can merge the two together. Don't worry about what they consist of and the various members, we don't care. We have been trying to bring together GAAP and IFRS since 2002. The ultimate goal is to converge into a single set of high-quality international accounting standards that companies worldwide would use for both domestic and cross-border reporting. Today, the path toward that goal is the collaborative effort of FASB and International Accounting Standards Board to improve GAAP and IFRS and eliminate the differences between them. There are still some differences between them that we cannot resolve, so we still have not come to a decision 12 years later. Don't worry about that. If I'm not talking about it, guess what?
Doesn't matter. For now.
Don't worry about it.
Don't worry about it. There's too much, guys. Do you see there's too much? We're going to pick the keys, okay? Now let's get into, this is going to be a review for many of you all, but important. The balance sheet. Guys, my principles classes, you know what I do? The balance sheet. Think of a balance sheet as a snapshot in time, okay? I like visuals. The balance sheet presents a snapshot of the resources of a firm, the claims of the firm as of a specific date. Now think of this, guys. A balance sheet is normally stated, balance sheet for the company, blah, 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 as of December 31st, 2014. It does not say from January 1st through December 31st. It's a snapshot. Think of this. My books. On December 31st, I might look really good. I might look like I have $10,000 in cash. On January 1st, I'm at minus 20. Do you get how every transaction is going to change the balance sheet? So a balance sheet is a snapshot in a moment in time, okay? Just showing the financial position. It's not covering a period of time. It's a snapshot of one period in time. It shows your assets. It shows your liabilities and equity as a specific date, which is usually the last day of the year or the quarter. It also can be known as the statement of financial position, okay? Now, how many of you guys know this equation? I actually might even put that on the test just to give you an easy question. And those who get it wrong flunk the whole test. This is the most important equation any accountant will ever know in accounting. Assets equal liabilities plus owner's equity. I mean, you guys get what I'm saying. That is key to everything we do, and that also is representative of the balance sheet, isn't it? The accounting equation is representative of the income statement. True, false? False. It's the balance sheet. The balance sheet views resources from two perspectives. Specific resources the firm holds, or specific resources the firm basically owes. The claims on the firm by the persons or entities that provided the resources. So basically, resources that the firm holds are assets, but obligations that the firm needs to pay are claims. Those are liabilities. What are some of these claims? Some of these claims is debt, loans, accounts payable, bondholders payable, mortgages, taxes, payroll payable, you name it. Now, the income statement measures the financial results of the firm's performance. The balance sheet is the financial position, snapshot. The income statement measures the results of the firm's performance over a period of time. So important. Which financial statement covers a point in time? Balance sheet. Which financial statement covers a period of time? and cash flow, but income statement. It provides information about the profits or losses of a company that have been generated during that period of time by showing, basically, an income statement shows the income or loss or gains and losses of operating activities, you know, what it's normally in business to do, and by financing activities, if it's loaning money or borrowing money or buying or selling stock, and then investing activities, if it is purchasing or selling assets. Revenues measure the inflow of assets and the settlements of obligations from selling goods and providing services to customers. Revenues are ultimately the reason a company's in business. Expenses measure the outflows of assets that a company consumes and the obligations it incurs in the process of operating the business to generate those revenues. And then the difference, the profit or the loss, the net income or the net loss, measures the bottom line of the company for the period. So our revenues minus our expenses equal net income or net loss. Okay? Then we've got the statement of cash flows. This statement of cash flows is also for a period of time. It shows cash coming in, cash going out, and we usually divide it into 3 sections. Operating, which is the normal day-to-day operations of the business, investing, and financing. How does the firm bring in cash, and how does the firm use cash? It complements the income statement since it shows how cash flows different from accrual-based accounting. Let's maybe touch on accrual-based accounting a minute. How many of you all are familiar with what's called accrual-based accounting? Accrual-based accounting is we record revenues when they've been earned, not when they've been received. And we record expenses when those expenses are incurred, not when they've been paid. Cash flows predominantly show money coming in, money going out. So it's necessary to have both. We want an accrual-based system because it really is more accurate and really reflects the financial operating of a company more accurately. But we also need to see, is the money coming in, okay? Cash flows are helpful. Okay. Shareholders' equity, basically, I'm going to just say, provides the information regarding those people who own the company and what's been built up within the company from past earnings. Lastly, there are financial statement notes or disclosures that are required as part of the financial statements to explain the financial statements. I mean, guys, I'm a CPA, and sometimes I look at this stuff and I'm just like, huh? I mean, what is the average investor like? So we have, no, I'm just being honest with you. I don't think you want to hear that from your instructor, but I'm just being, why not be honest? At 53 years of age, who cares? It's Greek sometimes. So notes are needed to help explain numbers on the financial statement. And it's also what kind of depreciation occurs, how do they determine loss contingencies, what are potential lawsuit liabilities that are probable. You know, all these things we're going to talk about in this class. And then last, there is a section called the Management Discussion and Analysis, which all you know is that there's more information. Don't worry about it. But I want you to know, in the financial statements, we've got the balance sheet, the income statement, cash flows, disclosures, footnotes, and MD&A. I want you to know those, okay? And right now, there's a lot of information about ethics and all the problems that have happened, but I'm really not going to get into that in this chapter. When those of you who take auditing will get to deal with that within the auditing, in ad nauseum, okay? So